Chakri Lokapriya of TCG Asset Management joins us right now on the show with his thoughts as well. Chakri, good having you as always. Thanks for taking the time out today and on such short notice. Chakri, you reckon we could see some stability at these levels, or will it continue to remain choppy? Because if the US markets are anything to go by, it's very difficult to take overnight positions.
Good morning. The US is down about 15% so far year to date. Nifty is down more or less the same amount, same percentage. And India has a triple whammy in terms of more than corona plus the global weakness. And in addition, we have a banking weakness. So against this backdrop, I think it's not time to nibble in. I think it's best to wait by the sidelines.
Okay. The other question that it brings to the mind, Chakri, and I'm glad you've mentioned, is that maybe staying on the sidelines at certain cases might be a good idea too. Are you in the process of identifying pockets which could eventually make you interested in dipping your toes? I mean, are these the usual winners, which have corrected, the likes of HDFC Bank, Bajaj Finance and some of the others, because all of them have come down too? Or would it be spread across a slightly broader spectrum?
In the current environment, what I think we would like to do is basically continue to stay away from financials, even though they have corrected quite a bit, and start looking at companies which will actually benefit from lower input and crude prices. Companies like chemicals, cement, paint, all these companies have a direct proportion, directly fall their raw materials costs in relation to as crude price falls. Oil is down about 52% year to date over the last 12 months, notwithstanding the 20% fall you had in the last week. So against this, I think the input costs will come down dramatically. Yes, there will be demand destruction as well in India, but that kind of offsets each other. So those are the spaces that we will look to add on incrementally over time.
What about cyclicals, Chakri? Stay away from them?
The industrials, I think we should continue to stay away, because there are two things which are happening. One is you have a lower industrial activity in India. Now there is going to be lower industrial activity outside India. Companies like L&T, which get export orders, are likely we're going to see a temporary halt to those orders or a postponement. So the valuations are weak, so incrementally would we add? Clearly not.
Okay. The other point being, some of these PSU, public sector enterprises, ONGC for one, valuations being the cheapest that you're seeing it, but there's no takers. What would you do with some of these names? Because, aside from the fact that they've been touted as dividend yield companies, the stock price value destruction has been so high that it's not a selling point anymore.
You're right. ONGC, Power Grid, GAIL, Gas Authority of India, NTPC. Name all these companies. Now all these companies have changed their stripes. The government made ONGC by HPCL, wants to break up GAIL into 3 or 4 big companies. NTPC by name is a thermal company, and now it's going to do solar. So when things like that happen, institutional interest from outside India dramatically goes down. Valuations are unimportant, because then what are you valuing? Are you valuing it as a thermal company? Are you going to value it as a solar company? And then you don't have any clarity over the pricing. In the case of companies like NTPC, what's going to be the PPA agreements? And in the case of companies like ONGC, there are multiple cross holdings. So in these kind of companies, valuations can go far, far lower and yet remain unattractive for a institutional holder.
Chakri, you spoke about this question on PSUs and the fallout there. What about the MNC companies? They were the darlings. They were getting bought into at exorbitant valuations. They too would have come off a bit. Are there pockets within the MNC space which, from a business-wise, look attractive and you might want to consider them?
No, indeed. If your companies like all the staples, in spite of their valuations, I think are clearly safe havens one would buy into. IT companies, even though they're not MNCs, but they are still relative safe havens, because these are companies which have extremely good processes in place for distance working from home, offshoring, all disaster management setups, all these things are extremely well set up for both MNCs as well as for the Indian IT companies. And they would be able to cope far, far better and in fact deliver, there wouldn't be much of a revenue or EPS risk. Yes, there will be some cut, but not anything which will not come back in the following quarter. So I think in spite of the valuations of the MNCs, clearly yes, because their processes are far more robust.
Okay.
Chakri, while we've been talking about some of these cyclicals, and I want to focus on autos which have been written down completely in this move down, in this correction that we've seen. The likes of Maruti, while Tata Motors, has seen the pain and the pressure building up because of the kind of pressure China brings in, the others, two-wheeler space, Bajaj Auto, Hero Motorcorp, and even a Maruti Suzuki for that matter. I mean, the pain has been a bit more exaggerated here. Do you feel that probably it's time to even start nibbling into some of these names?
All the names that you mentioned, whether it's Bajaj, M&M, Tata Motors, all the valuations are clearly at trough levels. When I say trough, they all are trading at their 2008 lows. And today the world is in a far better shape than it was in 2008. Now, then what is the problem? You have an EV supposed cycle coming up at some point in the future. Well, now that's debatable. If oil remains in the 20s and 30s for a fairly long time, that kind of pushes back any kind of an aggressive EV implementation. But more in the near term, all the BS4 vehicles with each one of these companies, some of them still, are being sold at a fairly hefty discount. When there's so much uncertainty, and while these are all passing, the corona is just a passing phase, but clearly during that passing phase, the sales are likely to be lower than expected. So you're not going to see a demand catalyst. Valuation is the only catalyst. So it's maybe you can nibble in, but not go all in. Okay.
That's for the auto pack. We spoke about some of the companies like paints, and you mentioned some of them. These companies, and particularly Asian Paints for one, held fort strong in this correction. Right now, there's not even an iota of pain that you're seeing with regards to even selling because the valuations are high. People are still holding on to these companies, irrespective of the fact that some of the other good companies have seen profit taking. Some of these companies, not at all. What's your take here? And do you feel that at these levels, again, fresh investments, if you have to nibble into it, Asian Paints and some of these names are good to be in?
If there's incremental cash coming into the system for funds, and I think this is the space that funds would gravitate to, simply because for all the now the titanium dioxide and other input costs are even lower than they were a month ago, making them more margin accretive. So whatever shortfall you might see in demand, that is the top line slowing down, is likely to be made up in terms of a better margin of these companies in the coming quarter. So this is a fairly good reason when we're staring at a sector at a quarter where there's likely to be weakness across board. I think these kind of companies, including some of the chemical companies, they might take a revenue hit, but they are going to see the earnings to be fairly intact.
Okay, stay on. Chakri, take a moment to thank you, of course, for joining in today.